Hey guys, what's up, how's it going? My name is Rob and welcome back for another video. And in today's video, we're going to be talking all about building a dividend growth portfolio completely from scratch. So in today's video, like most of the videos I do on this channel, we're going to do this video from a beginner's perspective in mind here, and I'm going to be showing you guys how to build a dividend growth based portfolio and just follow some of the basic fundamentals here. If you guys remember, I think it was about a week or two ago, I did a video on how to build a monthly dividend based portfolio. So today we're going to switch gears a little bit and we're going to focus on dividend growth investing, and I'm going to show you guys how to build a dividend growth based portfolio. And this is actually my favorite type of dividend investing. And inside my portfolio and my stocks, I have a little bit of everything. I have some stocks that pay monthly dividends, I have some stocks that are more dividend growth based, and I do have some stocks that are more a bit of a higher yield. So I like to do a little bit of everything. But if I was to pick one type of investing that I think is the most important and the one that works the best for me, it's going to be dividend growth based investing. So we'll talk about some of the basic things you need to keep in mind. I'll show you guys some of the basic things that you need to look at when you're picking a company, and I'll show you guys some recommendations along the way. I'll show you guys some stocks that I think are good dividend growth based companies. So let's jump inside the video and let's start to look at some of the things that you should take a peek at and you should watch for if you're looking to build a dividend growth based portfolio. So the very first thing that we're going to start off with is a pretty basic concept, and it makes sense if we're looking for a dividend-based growth portfolio. We want stocks that are growing that dividend over time. So that's the first metric we're going to focus on. And when you're looking at stocks, it's really as simple as this. You want to look for companies that on an annual basis are growing that dividend. So I'm going to show you guys some cool little tools that you can use to basically achieve this, and I'm going to show you guys what you're going to kind of look for. So let's jump inside the computer and let's take a peek at some stocks that have some really good dividend growth rates, and let's talk about what you should be looking for when it comes to that. Okay, so the first stock we're going to take a quick little peek at is going to be Canadian National Railway, and this isn't your typical Canadian dividend growth stock. A lot of people don't see this as a dividend growth based stock. If you look at the history of the stock, it's performed pretty well. You know, lots of stock appreciation, lots of growth, and that's something you'll see with a lot of these dividend growth stocks. And we're looking at stock growth as well as dividend growth here. And you'll notice that the dividend yield is actually pretty small at this 1.85%, so just under 2% here. So one thing if you're going to check out the dividend growth rate an annual basis is you can just type it into Google. And website I really like here is Guru Focus. It's an easy one. You can type in, for example, you could type in Canadian National Railway stock dividend growth, and this website will give you a nice little overview of how much growth the company has had in the past couple of years or so. So we can see here in the past year, the dividend growth rate of CNR is 7%. 7% is a pretty good dividend growth rate. During the past 3 years, on average, the growth rate was 11%. So 11% is really good. I'd say anything over 7% is pretty aggressive, and that's really what you're looking for with some of these growth-based stocks. And you can see during the past 10 years here, the average dividend growth rate was 16% per year. So imagine your dividend growing 16% per year. And if you go down here, you can see more of a 5-year chart. Whoops, that shows 11.5% over the past 5 years. So that's pretty good. Like, that's pretty solid. Once again, anything over 7% is really good, and that's really what you're looking for. But this is how you can really kind of basically see if a company is a dividend growth based company, is how much are they aggressively growing that dividend. And anything over 7%, especially if it's got a lower dividend yield, is kind of what you're looking for. And the last thing I want to mention really quickly here is to pay attention to how often this company is growing its dividend. So if you can grab a company that's showing like 10, 20 plus years of dividend growth, or 20 plus years of consecutive dividend growth rate, that's pretty good. As you guys can see here, CNR stock has increased their dividend over the past 24 years, consecutively 24 years of dividend increases, and that's really what you're looking for, is companies that just are always growing that dividend every single year, and obviously the more years the better. The next thing we want to talk about really quickly here is earnings growth, and this kind of goes along with growing a dividend over time. So if a company is kind of growing, their revenue is increasing over time, they're going to have some free cash flow, and that's going to allow them to grow that dividend. So if a company has earnings that are increasing on an annual basis or a regular basis over time, it gives them more leeway and allows them to basically keep consistently to grow that dividend over time. And if we kind of compound that with a low payout ratio, and a payout ratio is basically how much of the stock's earnings that they're paying out in their dividend. So if a company has a low payout ratio, they have tons of free cash flow. they're going to just, if their earnings are growing over time, they're just going to have a lot of extra resources to grow that dividend, even during like a pandemic or something like that. So you want to look for companies that have a low payout ratio, and also companies that are aggressively, basically growing their earnings. It doesn't have to be super crazy growth, just as long as you see that consistent growth over time. That's really what you want to look for. So next up, when it comes to dividend investing, we always have to talk about yields, because yields are kind of important, even though there's a lot of different ways you can do it, and it kind of depends on where you're at. So if you're going to pick a company that has a lower dividend yield, chances are they're going to be a company that's aggressively going to grow their dividend over time. And you're going to grow it a lot quicker. But the thing you got to keep in mind is that if a company has a very low yield, like maybe 1% or less, it's going to take a long time before the yield really starts to add up. Now, that can still help you grow and get some good growth off the company. But if you're looking to maybe in the future to some degree live off your dividend income, within the next 10 years or so, you kind of want a company that already has an established yield, or you kind of want to have some companies at least to have that established dividend yield. So what I would recommend is kind of looking for companies that are in that 2 to 4% range. Lower dividend yield, you can look for ones that are 1% or 2% or whatever you want to do. Just keep in mind it's going to take a lot longer for that dividend yield to really add up, and it depends on your goals. If you're retiring earlier, if you're older and you want that dividend income to kind of compound quicker, you might want to pick a higher yield stock. But still, at the end of the day, you want to look for companies that are aggressively growing that dividend. So if you want a higher yield company, that's perfectly okay. Just make sure they're growing that dividend on a regular basis. And last but not least, my recommendation for you guys is just a really simple one, and it's something I recommend to a lot of people, is go for good quality companies that are well-known companies that have large market caps, that have a lot of finances, a lot of setup business, and they're just established companies that have a large basically history of doing all these things I talked about. So look for companies that have long-term histories of dividend increases. And in the next part of the video, I'm going to go over some stocks here from some different sectors, and just kind of really quickly talk about some ones from each sector that I think are ones you want to take a peek at. So once again, go for good quality companies, go for ones that have the long-term history of growth, go for the ones that have the long-term history of dividend increases, and that's going to probably give you the best bang for your buck. And you kind of want to mix up your portfolio to have a little bit of everything. So let's jump inside some of the sectors. Let's take a peek at some of the stocks that I recommend that you guys take a peek at if you're just getting started. The first company we're going to be talking about is going to be Telus Corporation. Now, Telus is a telecom-based company, so if you're looking for something from that sector, Telus is definitely something to take a peek at. Now, the cool thing about Telus is that it trades pretty cheap right now in the TSX. The ticker for Telus is T, as you guys can see here. It's currently trading about $27.51 Canadian. Now, Telus has had a lot of good consistent growth over the past 10 years or so, and this is definitely what you want to see as a dividend stock. But also, Telus has a pretty high established yield already, about that 4.6% yield. Dividend yield. And now the one thing I do want to mention is it does have a bit of a higher payout ratio, and that generally comes with stocks that have higher yields. But if you're looking for a stock that kind of already has established yield that's going to keep growing that dividend over the next couple of years and really start to compound, then this might be a stock you want to take a peek at. And if you look at the 5-year dividend growth rate for Telus, we can see that it's sitting about that 7% range. So still not super high as in being over 10%, but for a company that already has a well-established yield, 7% is pretty solid. So definitely a good stock to look at if you're looking for a telecom-based company. Now, when it comes to the finance sectors of the Canadian market, there's a lot of good quality finance-based stocks. I'm just going to pick one for this video, and that's going to be the Royal Bank of Canada. So that's RBC for short. The ticker is RY on the TSX, and this is a little bit more of an expensive stock, but most of the bank stocks are kind of a little bit more pricier, but at the end of the day, they're still good quality companies. RBC is currently trading at $125 Canadian right now, and RBC, as along with a lot of the other banks, has had tremendous growth over the past couple decades. They're just consistent stocks that just keep growing, so they have tons of growth. And as you guys can see here, it's got a pretty decent yield. It's got 3.44% dividend yield, so it's a little bit under Telus, but this comes with the benefit of having a lower payout ratio. So if I was to pick a stock that would have more consistent growth over the long term, I'd probably go with RBC. And if we look at the 5-year dividend growth rate, we can see that it is sitting at that 6.4%, that 7%. But we can definitely be sure that this company is probably more than likely is going to keep that, that 7% to 10% consistent dividend growth rate that it's been experiencing. So a lot of the banks are just good quality, consistent stocks. And if you're looking to add something from the finance sector, definitely consider one of the big Canadian banks. When it comes to energy stocks in the Canadian markets, once again, we have a lot of stocks to pick from. I'm going to go with a more conservative stock today that we're going to talk about, which is Fortis. Fortis follows the ticker FTS on the TSX. It's currently trading at $56 Canadian, as you guys can see here, and it is once again a really solid growth-based dividend stock. So consistent stock growth over time, and it's got a pretty lower dividend yield for an energy-based company. But once again, the benefit of this is that it does have a more lower payout ratio. Now, it's got a payout ratio of about 70%, which seems a little bit high, but for some of the Canadian energy stocks, this is actually on the lower side. So when you're looking at payout ratios, you also got to compare the sectors as well. So Fortis is definitely a more conservative stock, but it definitely is one of those stocks that has more consistent growth with it, as well as good dividend growth over time. It's averaging at 6% growth over the past 5 years. So it's not crazy growth, but it already has a well-established yield. So once again, you're kind of notice this trend. Stocks that have higher yields, generally speaking, will have lower growth when it comes to dividend, but that's okay because the yield is already well established. So you just got to kind of go with what you think and what kind of suits your goals at the end of the day. Now we're going to switch gears a little bit and talk about Elementar. This is a consumer-based stock. So if you're looking for something based in the consumer sector, which is there's not a lot when it comes to dividend stocks, not as many dividend stocks in the consumer sector that are more bigger stocks, but this is a company that I think is really coming up. So their ticker on the TSX is ATD.B. and they are trading at about $49 Canadian, and this is predominantly a growth-based stock. So we've seen tremendous growth over the past 10 years from Elementar, but they're also one of the bigger dividend growth stocks. Now, one thing to keep in mind is this is an example of a company with a very low dividend yield. So 0.71% is a pretty low yield, as you guys can see, but the benefit of this is this allows them to really aggressively grow that dividend. So their payout ratio is under 10% as at the time of doing this video, so they also have tons of revenue, tons of room for growth. If we take a peek at their annual dividend growth rate, we can see that it's actually sitting at 26% over the past 10 years. So once again, if you kind of buy into the stock now, you're kind of getting that aggressive dividend growth rate, and if you hold it for the next 10 to 15, 20 years, you can see tremendous growth from the stock. Now again, it's going to take a lot longer to get that dividend yield up because it is smaller, but you could probably expect more growth with a company like this as long as they continue to do well. So I think it's important to kind of share that example with you guys so you can see the different types of dividend growth stocks that you might be interested in buying. And at the end of the day, guys, if a lot of this picking individual stocks just kind of feels like it's overwhelming for you guys, a very simple solution to do would be to pick up a dividend growth based ETF. We've talked about this a lot on this channel, and I think ETFs are really good, solid investments. There's a lot of different ones you can pick. The one we're going to highlight in today's video is going to be ZDV from the Bank of Montreal. This is a Canadian-based ETF. All you guys need to do is buy this fund. It comes at a very, very cheap fee of 0.4% per year. But with buying this fund, you get 52 stocks that are good quality dividend growth stocks. So if we go down here, we can see all the different sectors. So you have 40% financials, 13% energy, 12% utilities, 11% communications. So you get lots of exposure to some of these different Canadian sectors. And here are the different companies that they hold. So once again, these are all good quality, big dividend growth based companies. And the ETFs are just a nice simple solution if you guys want a very easy way to invest in and kind of build a dividend growth based portfolio. Alright guys, so in a nutshell, that's pretty much everything that we talked about so far in this video. So I hope you guys enjoyed it. If you guys have any questions about, building a dividend growth portfolio, or if there's something I didn't explain correctly inside this video or too clearly for you guys, just leave a comment and I'll try to get back to you guys as quickly as possible. So let me know what you guys think of the video. If you guys did enjoy it, be sure to give it a big thumbs up, and remember to subscribe if you guys want to see more content and get notified from YouTube. So anyways guys, I hope you guys enjoyed the video. Take care. I'll see you guys later and have a good one.